We are on the air today. It is the first day of October. We just finished the quarter and the month, and now we're headed into the government shutdown. And who's better to deal with a shutdown than Charlie Peabody, Kevin Bakesbaker, and Nadine Terman here on Wall Street Beats, powered by Passes. You know, you were
I,
gatekeeping, Charlie, last time we were on. You were gatekeeping your names, short and consumer finance. So I know you've got a lot of charts for everybody today. So it's a chart heavy day with Charlie and Bakes on today. You're wearing your spicy hat, your volatility hat. So I'm going to pass it over to you because I know you got a lot to say.
yeah, I think in the absence of government data, we're going to have greater volatility in these markets. So that's why I'm wearing my Make Volatility Great Again hat. Also, in terms of shutdown, since you've got two people that grew up in Boston here, how about the shutdown by the Red Sox pitchers last night on the
Well,
Yankees?
I'm getting teary-eyed just thinking about it.
We'll give a shout out to the Red Sox pitching staff.
Amen.
Anyway, so listen, I've been away for 2 or 3 weeks now, and so I'm just getting back.
Don't rub it in. Don't rub it in, Mr. France. Don't rub it in. Go ahead.
Qu'est-ce que tu sais? Je parle français maintenant. Oui.
Uh,
Alors, so anyway, what I wanted to do is sort of just set the table with a little bit of perspective of what I've been doing really for the last year. I mean, if you go back to last September, I've been saying, that the two trades or the trades on the short side that I thought would work would be broken into two legs. The first leg would be one around affordability. And I said those things that needed to be financed would disappoint. And I was talking about home builders. I was talking about RV sales. I was talking about motorcycles like Hod. RV sales would be Winnebago. Home builders would be Lennar, D.H. Horton. I had a list of sectors that I thought that would work in that first leg on the short side. And in fact, when the market was going up to make new highs by January of 25, these stocks like Lennar and D.R. Horton were down 30-40%. So that really did work. And then in the spring, I said, be careful. These things are, over anticipating a decline. And I thought we could have a contra trend rally over the summer. And we have in many respects in a lot of these names. But I said there's a second leg coming. And that second leg in all of these names would be defined by rising unemployment. And that's where we are right now. And I think you can go back in on the short side of a lot of these names as the unemployment rate and gets worse. And I'll throw something out there, do with it what you want, but I think
yeah.
there's a really rising chance, a high probability chance that by the first half of next year we're in a recession.
Okay.
Um,
Going
and that's
big here
that's
on
what I'm.
October 1st. Charlie's going big
Yeah.
with the R word. He's bringing out the R
Um,
word, everybody.
and I've sort of made that comment in the past that I thought by the end of this year we'd be seeing credit deteriorating in a way that would increases the chances of a recession. So Jen, if we can go to the first chart, I
Wait,
just want
before
to
you
bring.
go there, though, before you go
Yeah.
there, like I'm looking at Winnebago, they already have short interest of 10.5%. Like are there names where maybe they didn't crack before and people aren't as worried versus the ones that already showed sign of weakness? Because I hate shorting things that are already so short because I try to be a little bit more non-consensus. Are there any areas that haven't cracked that you're like, oh, the recession surprise would surprise these names?
Yeah, there are, Nadine, and I'm going to get to that. But you're absolutely right. So the first leg down was
I'm
things that
impatient,
needed.
Charlie. I'm so
I
impatient.
know you want the conclusion. You want the conclusion.
I want the answer.
I'm trying to build some suspense here, and get you, pull you in bit by bit.
Yes. Okay. All right. All
But
right.
you're right. The first leg was things that needed to be financed would disappoint, and that was home builders, that was RVs, that was motorcycles. The one
Mhm.
area that did not work in that first period was the auto area, and that's the area
Mhm.
that is starting to work now as unemployment rates rise and liquidity. Actually, I just mentioned this up front because this is also data that we're not going to see, but last week, you got first signs of liquidity stresses in the system, in the sense that excess reserves in the banking system fell below $3 trillion. And typically, in an ample reserve monetary system, which is how we run the country now, you need reserves at least equal to 8 to 10% of GDP. So if GDP is what, 30, 35 trillion, let's call it 32.5 trillion, you need 3.2 trillion of reserves minimum to be in a stable situation. Reserves last week in the banking system fell below 3 trillion for the
Yeah.
first time in quite a while. So we're starting to see some drainage of excess reserves that is creating
Yeah.
some liquidity constraints. Why that's important is also, if you look at the H41 Fed release last week, you saw that discount window borrowings jumped to over $7 billion. I think it was like $7.8 billion. That's the highest number of discount window borrowings we've seen in the banking system since the Silicon Valley days. So it does say that the banking system is stressed. I obviously would love to see Thursday night's numbers. These come out every Thursday night, but unfortunately, with the government shutdown, we're not going to see it because some of that stress could have been related to quarter end window dressing problems. But if it persisted, we know it's more than just quarter end. Anyway, I'm sorry, I got off topic here. So let's go back to that jobs number. Nadine, you waylaid me. I'm blaming it on you.
All right.
So in the absence, with the government shutdown, in the absence of government numbers, we're not going to get the jobs number this Friday, I don't believe. We're not going to get continuing claims tomorrow, I don't believe. So we have to look to private sector and things like ADP this morning, which was very weak. I think we lost 32,000 jobs this morning. Things like the ISM data or the Consumer Conference Board data. Is what we're going to look to now for guidance on how strong or weak the employment situation is. And this is the last report from the Conference Board on consumer data. And it plummeted in last month's release.
Yeah.
And the subset of the Conference Board consumer confidence is one that shows, whether jobs are plentiful or not.
Yeah.
And, this is a critical measure to watch in the absence of government data on jobs. And here we saw a rapid decline in this figure, and every time we've had this kind of decline since 1967, it has been followed by a recession. So I think this, steep drop off in the consumer assessment of the labor market is a very concerning signal and could foreshadow, what I thought was going to be a weak jobs number this Friday, but we're not going to get that. And if you go back and look on Wall Street Beats, all of my last month of writings was about how jobs data would trump inflation data. So inflation data has remained sticky, but jobs data was getting weaker and weaker and weaker, and that's why I thought we would result in some sort of Fed easing cycle. But the Fed easing cycle is being driven by weak economic jobs data.
Not good, right?
That's not positive in my mind.
Yeah. So it's funny, Charlie. So I have on that free arrows note out this morning. I actually have a long section because also Bloomberg has really good charts on this today. And one of my conclusions was just that, as you just said, that the equity market likes it when you cut into a good economy, but it does not like it. Risk assets don't like it when you're cutting into a soft economy. And I think what you're saying here is you're tying that labor data to the economy. So maybe square the circle on how have retail sales in some areas been so strong, right? Like, how has it been so strong? And some companies are having a harder time, but then other companies are just like, I continue to get surprised at people spending. Is this really just only the rich? Is it because equity markets have been up and then you're going to see, call it a double whammy if equity markets are down? Or how do we view like that trend, which is, in some ways, looking back with the fact that people are a little bit worried about their jobs?
Well, I think that can be explained, at least, looking backwards, by the K economy. The subprime
Yeah.
sector is definitely hurting, and that's what we're seeing in the credit numbers. And, I think it's what the top 10% are accounting for over 60% of the spending in the economy now.
Right.
But even there, I've pointed out, if you go back to Ralph Lauren or Tapestry or some of the high end names, they're talking about a weakening consumer or a slowing
Yeah.
consumer, let's say.
Yes.
So I I think this bleed through from the lower end to the upper end is going to occur in the fourth quarter, and that's what I wanted to come back to in some of the charts. Let me just run through some of these charts very quickly. Jen, if you can put up the next chart on jobs. Yeah, that one. So this is core U.S. payrolls. The 6 month percent change. No, yeah, that one. Sorry, thank you. And it's very rare to see periods like this where where employment is flattening, and by rare I mean it almost never happens. But when it does, and it slips below zero, it's almost always been the start of a material contraction in employment. And that's what ADP was signaling today. We had a contraction of 32,000. They revised last month down to negative 3,000. So I think this next leg of the bear market in credit is going to be related to higher unemployment rates.
Okay.
So let's go to the next chart, two charts. Yeah, this one. So I'm of the belief that we are going to see volatility pick up here, which is why I
Right.
was wearing that hat this morning. And one of the reasons is because of the leverage in the system. And here I look at margin debt carry load, which is basically the cost of carrying margin, and it's at all-time highs. And so I think it's going to be very difficult if we have, some correction in the stock market to maintain these margin positions, and that could lead to even greater volatility. The next chart, I think, is just another margin debt. This is just looking margin debt as a percentage of nominal GDP. You can look at it as a percentage of market capitalization or GDP. And again, it's at historical highs. I think the great financial crisis is the only other period where margin debt has not been this high. So it's just another way of saying I think the volatility related to a weakening jobs market is going to increase, and that's going to create some significant opportunities on the short side in credit related names. So
Hmm.
let's go to some of the names because Nadine has been pushing me, to get to names.
Yeah, I don't like to have gatekeeping here, whether it's, TikTok makeup artists going to, their drugstore or whatever, Charlie, or my stocks, I need to know.
Yeah, macro doesn't make you money. It's the names that make you. Although I've done well on the macro. I mean, I wish Ben was on today because the
Hey, be nice.
Yeah, hey.
as
No, the
Biggs,
perma bear, the perma bear, I talk to him every
I
day.
wish Robert and Marshall were on today. If we're going to be that way, let's go.
you know, you
Okay.
know, Biggs, you and I have been fighting Ben on this idea that physical gold, has done better than the gold miners. But I've made two very in-depth presentations this past spring. One on the PGMs, particularly platinum, and the other on silver.
I
And
listened to you. I bought them and made money, so thank you.
both silver and platinum have outperformed gold. I'm talking about physical metals,
Yeah,
outperformed
yes.
gold year to date.
Yeah.
And the gold miners have outperformed physical gold today. So take that, Ben.
He's gonna bring up the January 1st, 2000 start date. It's gonna show up
No,
any minute now on our
yeah,
feed.
no, he's gonna start
It's
talking about
coming.
the SOFR curve. So anyways,
Anyway,
he let
Anyway,
me vent.
what I'm going to associate with this next leg of the bear market is it's going to be credit related as opposed to financing or affordability related.
Okay.
And that credit related bear market is in my names that I'm looking at, is going to be associated with a rising unemployment rate. So where we've seen this start is in what we call the tertiary trade. These are the lesser, smaller, consumer finance names, BDCs, private equity, private credit. Jen, if you can bring up that first chart of, I think it's Upstart. Yeah, yeah. So this shows the performance of Upstart, which is a buy now, pay later, versus the XLF. And this trade, as I mentioned to Nadine before I went on vacation, I'm starting to short some consumer finance, BDCs, alts, non-banks, et cetera. Um, and we call this the tertiary trade. I think people have been putting this on over the month of September. Yesterday, I think it was BTIG put out a piece saying that the securitization data at Upstart showed significant deterioration. From what I hear, they made a mistake on some of their data calculations. So I don't know where that's resolved today, but it did set off a sell-off in some of these consumer finance names, which had already been under pressure. So that's why I wanted to bring this up first, just to make you aware that this report on Upstart's securitization data may have had some misleading conclusions in it. So just be aware in case we get a snapback today. But I think the general conclusion is we are starting to see deterioration in consumer finance. So let's go to the next chart. Dan, if you can we'll go through these very quickly. So we're seeing, deterioration on the consumer finance side across a number of sectors. The one sector that's gotten a lot of visibility has been the auto sector. And I mentioned about a month ago, the very first credit to get into trouble was automotive credit acceptance, ACC. That's not getting much visibility right now, but it was a Michigan-based subprime lender that had to stop all originations because they were having problems. The things that are getting a lot of visibility right now are Tricolor and First Brands, but the original canary in the coal mine was Automotive Credit Corp. But so people are focused on the auto sector as an area that's seen a lot of credit deterioration, but it's broader based than that. If you look at the securitization data of Sallie Mae, you're seeing credit deterioration there. And keep in mind, starting October 1st, today, the people that had been granted forbearance on their student loans have to now start paying. So I think it's going to get more difficult for these student lenders. We can go to the next chart. Can you bring that into focus a little more? Anyway, Navient is another student lender that where the chart is starting to roll over. I'll leave that to Bake to decide, but it looks to me like it's rolling over. I will tell you from the commercial banking point of view, the commercial banks have been trying to sell off their student loan portfolios. The biggest one that's in the process of doing that right now is Citizens Financial, CFG. And they're trying to sell a $10 billion student loan portfolio. So they do see, the industry does see problems emerging and are trying to de-risk those portfolios. If we can go to the next slide. This next series of slides are showing, the private credit and how it's trading relative to the primary names. So that's why we call this the tertiary trade. It's the non-banks versus the core banks.
Yeah.
And you can see they're performing very poorly. Blue Owl, which is a big data center software lender, is experiencing price weakness relative to JP Morgan. If we can go, by the way, we are starting to see, pickup in defaults in some of those software names. And Blue Owl is become a big PIK lender or PIK lender, so they don't have the cash flow that maybe some of the others have to support, their operations. Let's go to the next. I'm just going to run through these quickly now because there's just too many of them. Jen, the next one. Just again, another JP Morgan versus KKR, and you can see the outperformance of JP Morgan versus a tertiary name like KKR. Next one, Jen.
But explain that though. Why is KKR down so much? Why do people is it their underlying portfolio companies are going to have problems, or is it a liquidity issue? What's going on?
It's a combination of those two. There is belief that there is credit deterioration in this small middle market names and the inability to monetize your portfolio. One of the interesting factors is we've seen a huge pickup in M&A this year. But if you break it down by size, The pickup has been in deals 5 billion or greater. If you look at
Yeah.
deals a billion or less, it's flat year over year. And that's the core portfolio of a lot of these private equities and private debt and BDCs is they are lending to middle market companies, not to the large cap companies. And so we do believe that that's where the credit deterioration is occurring. In fact, we don't get a lot of small business data from the banking industry, but the two companies, and I wrote about this actually in one of my pieces on Wall Street Beats, the two companies that do report small business data, which are Bank America and American Express. And by the way, American Express looks like it's about to roll over here. So I would take a look at that on the short side if you're a trader type. But both Bank of America and American Express report small business data. And we saw deterioration in the second quarter in that small business data. And that's the core of these portfolios of these BDCs.
Okay.
And so next chart, I'm just going to do this just to give you some examples of, skip that. Let's skip that. That's just, no one wants to read anything. They want to look at pictures. Skip that next to the next one, Jen.
I like pictures. Yeah, Apollo.
No, yeah. So
Same story with Apollo.
again, the XLF, which is weighted with J.P. Morgan and Berkshire, the primary high quality names versus Apollo. You can see that the divergence. Next name. I'm just doing this to give you a sense of how names are trading relative to. So this is Blackstone's specialty lending. Again, performing very poorly versus XLF. Same thing
So
with.
is the news already in there? So for someone looking at these, like, is the trade done there, or is the trade just getting started?
I think the trade from a 9-month point of view, the trade is just getting started. Where I'm going to conclude with this is we've seen such a divergence now that I think the bleed through from these tertiary names to the primary names is going to become more visible in the fourth quarter, let's say by November,
Okay.
December. And so I think the primary names are very vulnerable to closing
Okay.
that gap. So next name, this can you bring that into focus? Oh yeah, this is another specialty lending vehicle of KKRs. So we can keep going. Again, it just shows the divergence. So if you can go to the next one. Hercules Capital is a tertiary private equity company that we believe has some problems in their portfolio and that has not been marking to market some of their stress names. We know some of the names they hold that other people hold, and we believe that they are, that's one of the problems with private equity and private credit is they are not subjected to the same disciplines in marking to market their portfolio. So this is a name I actually am short. It hasn't worked as well as some of the others, but I believe that there are issues in their portfolio. Next one. This is all right. So now we're getting into the credit card, but Capital One also has a big auto portfolio, and you can see it relative to credit acceptance has done very well, largely on the back that the merger with Discover will produce all sorts of benefits. But one of the benefits is when they did that merger, they took a one-time mark-to-market charge of Discover's portfolio, which buys them time with respect to showing further credit deterioration. In other words, you took their whole portfolio, you marked it from 100 cents on the dollar to 90 cents on the dollar, and that buys time. But one of the pieces I wrote on Wall Street Beats was about how these companies have been using loan modifications to suppress the deterioration of their portfolio. And Discover was one of the more aggressive users of loan modifications in suppressing the deterioration of their portfolio. So that's why I put this one up there to show that if credit acceptance, which doesn't have those merger benefits, is showing greater deterioration than Capital One. But those jaws are going to close sometime in the next 6 months, I think. All right, next one. This is just, CarMax had some very poor securitization data prior to reporting their earnings. And then on their earnings, there was a big jump in their loan loss provision. which scared people. And that's something, to learn and take away when you look at these, AI names like CoreWeave or NVIDIA. They're financing their customers to buy their product. And,
Yes.
and that's what we've been seeing in this consumer finance space. Is if you're financing the product sales and to people that really can't afford them, it's going to come back to haunt you. And I think you're going to see that in the AI space as well. Next chart, Jen. Okay, so another buy now, pay later company that reacted yesterday to Upstart data. So I think that's where I end, right? Jen, is there any more? Does that be it? So the bottom line is, I do think we've entered that period where credit is going to deteriorate. The important part of this is the setup is as follows. Over the summer, since April, since June, July, April, June, July, the generalist portfolio manager has been buying financials hand over fist. And they are always the last incremental or marginal buyer of financials in a cycle. And they don't understand credit cycles as much as the dedicated financial analysts do. And so once they see to them, bank balance sheets are black box. And so once they see credit deterioration, they are quick to pull the trigger and sell. And that's a very important setup to understand why I think we could have a good 20-30% pullback in some of the primary names like JP Morgan or even Citigroup, which has been my number one pick, in the fourth quarter, is because these generalists are going to be quick to sell before they ask questions. If the credit cycle starts to show deterioration, and I think it will. At the very least, the seasonals will tell us that credit is deteriorating at least between now and next February. And the question is, how deep does it go? Does it drift from these tertiary names up to the primary names? And I think it will. So let me stop there and open it up.
So can you just short the XLF, or is it better to be surgical and pick the bigger of the group?
You can short the XLF. I mean, one of the trades that I think is being looked at, I don't know how much it's been used, is FAZ, which is, I think, like a triple leverage short of the XLF. Is it triple leverage? Nadine, I don't have it up.
Yes.
Yeah.
Yeah. One thing I'm going to caution here is the XLF is basically J.P. Morgan and Berkshire Hathaway. It isn't entirely, and making Berkshire Hathaway go down significantly is brutal. So I would go for further away from the watering hole where the wounded gazelles are, and go after them rather than the lion in the middle of the field. So that's shorting Berkshire Hathaway is tough, I think.
Yeah, I don't disagree with you, Bakes.
All right, Charlie.
You've got JP Morgan literally at 3 times tangible book value. And while their earnings numbers here in the third quarter are going to be very positive, as it will be for the industry, and I'll talk a little bit more about third quarter earnings expectations on Friday when I'm back on. But
so do you wait? Do you wait to short this stuff till after?
I don't think so.
Or do you do it now? Are they going to give hints at this?
I think you do it now, and I think we're going to see some volatility, around these job numbers and lack of government data. Keep in mind, one of the things that has really been supportive to the primary names is the huge share buybacks, and we're in a blackout period right now where they can't buy back. So I think it could be one of these things where it takes a quick 5 to 10% drop between earnings. So earnings start on the 14th of October, and then you rally on the good news of earnings. Although I can pretty much guess that the Jamie Dimons of the world are going to come out fairly negative on the macro in their comment. So
he's never come out positive. I mean, he's a walking barbiturate.
Yeah, no, you're right. But so the earnings will be positive, but I think the commentary will be cautious, particularly on the credit side. So.
Okay. Well, that's a lot of meat there in that hamburger you gave us. So thank you for that today. Thank you. Bakes, what are you seeing?
I didn't go to France and get well rested, so I'm gonna be a little more
Yeah, you and
hurt, I
me,
think.
Both.
Yeah. Okay. My first one, and this is, the Charlie kind of idea. I just bought this on the open today. And this is what I like about Wall Street Beats. We talk about what we're actually doing, it isn't theoretical. So this is MJ, Mary Jane. Isn't that cute? Amplify Alternative Harvest ETF, and it's cannabis. And I picked this one because it's subjectively, to my eye, the best looking chart. And the components of this ETF look very similar. There was a story that I didn't see on when I went through the AI engines, and Charlie brought it up to me that President Trump was on a video talking about the benefits of CBD for seniors and Medicare coverage, which would be absolutely monstrous. And this situation here is, the cannabis investor has had Lucy take away the football so many times that it won't take out new highs until they see the whites of their eyes. That's a kind of cool phrase. I just thought of that. Anyway, so I bought about 3% of the portfolio. It's down about 3% today. It's down 2% now because I think by the time you get an official, the real one is going to be the reclassification. Schedule 1 is not heroin and fentanyl. It's a class 3 drug. And when that happens, then all these companies can get banking relationships and financing, and the Canadians can get U.S. listings. And, look at, this knife is on the floor to my mind. Now, there's all these things here are false starts. I get it, but I'm just envisioning. And my next job after I get off this call is to explore why the anti-cannabis lobbyists can't touch Trump, or why this is a Trump favorite industry here. I don't really know that right now. Maybe Charlie does, but my point is I'm buying this on low volume dips here because by the time it gets the news, we're going to rip through 40 and probably tack on another 5-10 points with no trouble going up to this 50-60 level. So I think this is turning around. This ETF, you own almost all the Canadians and almost all the U.S. I can't think of a name of any import that this doesn't own, and I think that this is going to rip if and when we get their news. Caveat, anything down 15%, I shoot. So if this goes down 15%, I'm not going to talk about it until it shows up on the buy list again. But I'm bullish cannabis, and I'm really bullish cannabis when the reclassification happens. But it's going to spike when that happens, and so buying in at that point is going to be really, really tough. So that's what I've got there.
So my question to you,
go ahead, Charlie.
Sorry, are you dating Mary Jane or are you marrying Mary Jane?
I don't marry. I marry my lovely wife, who's in the next room. Hi, hon. I don't marry I don't marry any stocks. I mean, if it's down 15%, it becomes Old Yeller and it goes behind the barn. But what draws my attention to this is just the possible. You can use any kind of Fibonacci retracement you want. This peaked out at 550 in 2018 before COVID. So will we get there again? Probably not, because that was probably crazy. But, could you retrace 50% of that and get to triple digits? I don't know. But, I go through 5,000 ETFs and I find the best 10. And this is one of the best 10, in my opinion.
No, the reason I asked that
is this, though, is that this pop, though, that you're basing that on has that news in it. It was the top story on Bloomberg. And I'd written about it last week. So it's not like an unknown that this will do well. And, it seems to me that you're either a long-term holder in belief that will happen, because this easily can come down in a few months if nothing occurs, right? Because people bought it. This pop, that momentum that you're seeing is because of this news. So unless you have a view on timing of it occurring, I'd be worried about that 15% level, because you might get down 20, but then up 70. Like, you know what I mean? Like, you kind of either have to be a buyer, or, uh, I guess maybe flex your window here a little bit, or wait to know that you have conviction around timing. Like you said, like it's yeah, there's been momentum, but it's based on that news flow, and the news flow doesn't have anything backing it quite yet. I only say that because I've traded and watched this for a while. I'm not saying I don't think it will happen, but I think that the time frame is if you try to connect the time frame to that 15% level, it might be a more difficult trade.
That I was going to say, that's why I asked that question about dating versus marrying Mary
Yeah,
Jane. Is I actually think you have to marry it, because
yeah,
this, to me, has the possibility of replicating what happened to Bitcoin. So right now, no institutional investor can own any of these stocks. And I can tell you that I work with a trade through a private bank, and I can't even buy U.S. names. I can buy Canadian names, but I can't buy U.S. names. So there's a whole process that that's going to mirror what happened with Bitcoin, that is going to make it an institutional possibility. And so I really believe if you take a longer term time frame, you're going to get triples and quintuples in these names. So I do think, Bakes, you're going to see that $5 number again. Now, whether it happens in the next 6 months, I don't know. But there is a process where the institutional investor is going to be, this is going to be part of their investment
portfolio.
possibility.
Yeah.
And
It'll be
that's
in their healthcare bucket, right? Or consumer bucket. It'll be in their bucket. But yeah, I agree with you, Charlie. I think you have to marry it.
Yeah. Anyway, sorry.
Put it away and don't look at it, because you could get upset.
Well, from what Bakes told me, you can't look at Mary Jane.
Yeah, that's true. His wife will get mad. So on that positive note, we care about your wives. We care about your SOs here at Wall Street Beats. Keep them in mind. Thank you, Charlie. Thank you, Bakes. It's Nadine here for Wall Street Beats.
I got a couple more if you have time, but if we got to go, that's okay. I'll do them on Friday. I can do Friday.
All right. So, awesome. Thanks, everybody.
Keep smiling. Thank you.
Thank you.
Yeah, I didn't notice the time.
Sorry, it's 7:40. I just figured it's a bit. Yeah. At least now you got your Friday stuff done.
I have got to run, gang. I'll see you Friday, Charlie.